So John, walk me through the way you see the relationship between the stock market and the economy right now, given that as we see some of these signs of improvement show up in crude and bonds, yields climbing, it seems like the market maybe has a complex view of what that means.
Yeah, hey, Oliver, good to see you. Happy New Year, and thanks for having me on. I mean, I would assume that all the economic data that's going to be released over the next few weeks, it's all backward looking, right? It's all what happened in December and prior months. And I would assume that that we're going to miss most of those numbers, to be honest with you. I mean, it's hard for economists to predict in the environment that we're in. And, we've had a rollback of the economy to some degree because of the rising cases of COVID, because of the holiday season, because of the warnings from the CDC and so on. So I would assume that the economic data that comes out, which was backward looking, we're going to miss those estimates by and large. But this is, a back half of the year story, and the whole context of where the market goes and where the economy goes. It's ultimately going to be a function of how fast can the vaccine be distributed and what's the acceptance rate of the vaccine amongst you and I. How willing is everybody going to be to take it? And once we get past those hurdles, which I'm hoping is closer to September, October, that we can start putting this socially distanced economy in the rearview mirror.
John, what do those data point misses mean if we get them at this juncture? Is this stock negative? Is it Russell 2000 and value negative? I mean, what's the connection right now between the data and the market?
Well, I mean, without having the crystal ball, my sense would be that it would offer near-term choppiness to the market. You'd have increased volatility, I would assume, as if my forecast is right, that we'll miss more of these economic numbers in the short term. But I think sell-offs in the stock market would be used to as buying opportunities. Now, that being said, Oliver, I thought there were two risks, coming into the year in the market. The first one I just highlighted, which is on the vaccine, and the second one was, the Georgia election. I was sort of thinking that, had we had a blue wave sweep, that the market would take that as a negative signal because it now gives, Biden probably about 24 months to pass through an increase in the corporate tax rate, which is clearly a headwind for stocks, and we've sort of ripped out of the gate here to start. So in the short term, who the heck knows? But in the long term, all the trends are that the consumer is ready to rip. We just got to get through COVID. And when we look at the laws of supply and demand, the one thing in the world right now where there's an excess supply of, it's cash. Money market funds are at all-time rates. Corporations are flush with cash. The cost to borrow money is essentially zero. I mean, there was a tech company that issued a convertible bond today, 2026 convertible bond with a 0% coupon. I mean, that's unbelievable. The 30-year U.S. Treasury is at 1.9%. People are refinancing their mortgage. So, right now, what the biggest issue that people have is, where do you put your dollars? And that's why we've seen an increase in M&A activity. We've seen an increase in the activity in the IPOs. We've seen, the emergence of SPACs, special purpose acquisition companies. People are looking for a place to park money now that we've gone through, hopefully, the worst of COVID here. We're clearly on the back end of this. And I think, sell-offs in the stock market are going to be fine with buying opportunities.
John, one data point that the market may be okay missing would be tomorrow's CPI. I think inflation on everyone's mind right now. Everybody expects the bond market to be very calm, even as yields rise. It's not going to get in the way of anything. But already we're seeing a pretty quick move here in the 10-year over the past 2 weeks. What happens if we come in hot on the figure tomorrow, or if it's not tomorrow, generally what should we expect to be that relationship with inflation, where the Fed has said that we're going to let it run hot, but it seems that the bond market is already moving without any hot. Has anything changed here over the last 3 weeks? I mean, really since August, the Fed has been just as dovish as anybody would expect. Inflation trends haven't been building, and the 10-year yield is just kind of running away.
Yeah, I mean, inflation has been and continues to be the ultimate show me story. I mean, if you go back to the subprime crisis when the economy was brought to its knees, and at the time was considered unprecedented money printing by global central banks, and guess what? We barely had 2% inflation over the next 12 years. Well, now the global central banks have printed twice the amount of money, have purchased twice the amount of assets that they did back in 2008 and 2009. And, the Fed's targeting an average inflation rate of 2% over a rolling 12-month period. So, the market right now in the bond market, particularly longer dated bonds, continues to price in that inflation just really isn't that much of a story. And it's true that it's going to take a while for inflation to rear its ugly head, which is why the Fed is telegraphing a 2023-24 timeframe to start increasing interest rates. But that's not what the bond market's going to move off of. The bond market's going to move off of, in my opinion, a rollback of quantitative easing, right, of the Fed stimulus policy. It's not when are we getting to interest rates. It's when is the Fed going to start tapering its quantitative easing program? When are we going to have taper tantrum 2.0 like we did in the spring and summer of 2013 when Ben Bernanke said, well, the Fed's going to start tapering its asset purchase program. And we saw the high quality, longer dated high quality bond market sell off like 10% in a 4 or 5 month period. That's kind of where we're set up today, is that as the Fed is not going to raise rates, but it's going to start walking back from saying we don't need to buy investment grade bonds here. We don't need to buy agency. We don't need to do this. And once they start saying that, it's the language out of the Fed that you're going to see start pricing into the bond market.
Well, John, here's what I'm wondering is that I like this point because it's not so much about hikes, it's about the step before that, which would be just, letting off the gas. Or to your point here, actually, I should be more specific. It wouldn't be necessarily letting off the gas. The Fed has already done that. What it is would be actually removing the amount that they're buying from the market. But that's where I think what's so interesting here is, are we getting evidence since August that perhaps they don't need to actually taper, that letting off the gas, that kind of second order of not putting any more in is already enough? Because that's where the bottom in the 10-year yield is. That's where the top in gold is. That's where the bottom in the dollar is August, the first week when the Fed said we're not going to put any more in. Right.
Well, I think Chairman Powell said it great the other day. We're thinking about tapering, right? So now the difference between COVID versus the subprime crisis or a typical recession is COVID is, we turned a light switch off for the economy, and now we're turning it back on as the vaccine rolled out. This is very different than 08-09, where we had to take massive leverage out of the system, and we incorporated massive regulation in the banking system, which dragged out the recovery. This is very, very different. So I think what the Fed is thinking about is, okay, now that the light switch is turned on, now that we have the vaccine starting to roll out into the economy, now we have to see the acceptance, and now we'll see how this impacts the overall economy. What next? How do we now roll back our stimulus in step-by-step fashion? And that's what the Fed is thinking about. And I would assume that as we get to March, April, May, they will start talking more about that, and you're going to have even more of a reaction that you're seeing in the bond market. Look, the U.S. 10-year Treasury was at 0.5% in the beginning of August. So your yield on the U.S. Treasury was 50 basis points. That is now more than doubled. You're now at what, 1.15%? 1.15%. So, it's not on an absolute basis. That's still a very low level. It's not like the Treasury is back in 1982 where it was 14% or something like that. But 100% move increase in yield is a big move in the bond world, and I think that's a part of the volatility of the market that investors are not appreciating. And Oliver, just a sort of public service comment here. This is the time of year when investors, put their list of, New Year's resolutions and financial New Year's resolutions. Well, I think everyone should be looking at their 401k, IRAs, things like that, and just understand what your exposure is to longer dated bond funds. Yeah. That's the key here. And it's not, I'm not saying go to zero in longer dated bond funds, but make sure you're not too far out over your skis when you're looking at your overall asset allocation plan from how much exposure do you have to longer dated bond mutual funds, because I think that is where there could be risk in people's portfolios.